Is it a house? Is it an office or not? What's up, guys? Before we get into today's video, I want to do a quick primer on why income types, where they come from, matter. There are two types of, well, in this particular case, we're focusing on two types of income. We're talking about ordinary income and passive income. If you own a business, ordinary income is the type of money that you generate from just delivering what you specialize in. For example, if you're a doctor and you're delivering services to your patients, the money you're getting from that process is called ordinary income. If you're a lawyer that litigates on the bench, the fees that you charge your clients would be considered ordinary income in the course of business. An example of passive income would be the money that's generated from a rental real estate property. An important thing to keep in mind is that you cannot take ordinary income and passive loss and combine them to reduce your tax burden. They have to remain separate. The same thing goes vice versa as well. You can't take your ordinary loss and count it against passive income. So today's video is all about figuring out how to combine those two income types to reduce your total tax burden at the end of the year. All right, we are on a field trip today. So we are currently walking down one of the busiest streets in Indianapolis here. It's called Keystone Avenue. So on any given day, this street can average 35,000 cars up and down, north and south, throughout the city. So along the street, we have a few houses. So what we have are houses that are doubling as office buildings for law firms, for dentists, for counselors. We have street signs here, some of you might see, where these professionals are marketing their business, providing phone numbers, websites that individuals can visit. So keep in mind how they look, and what you may notice is that these are houses that people can live in. They're houses that have parking lots behind them, houses that have private entry, so multiple doors to enter into the office, houses that have legitimate signs, signs that can serve as billboards. So they're houses that operate, that can kill two birds with one stone. So what some professionals will do is they'll use these houses to house their part-time office, full-time office, and then they'll put the house on the market for midterm rentals or short-term rentals. Short-term if it's greater than 30 days in average. And once you do that, you can elect to absorb the losses from these rental properties that you're renting out to families on a Vrbo and Airbnb. You can absorb that loss as ordinary income for your business and reduce your tax burden. So next time you see one of these house offices in your city, don't sleep on the potential opportunity that's available for you to maximize your tax deductions and keep your money. That's right. Section 1469-4 of the Revenue Code will give business owners the opportunity to combine more than one business that are different types of businesses, one earning ordinary income, the other earning passive income, into one entity that earns ordinary income and that is generating losses from what was formerly a passive operation. There are a few key facts and circumstances that have to be passed in order for this election to be legal and effective. Some of the main circumstances are that the companies cannot be related to each other. They have to be two separate types of business operations. Another key circumstance is that the ownership entities have to be the same. So they have to be either a partnership, both partnerships, and if they are both partnerships, the ratio of ownership in each partnership has to be the same. So if it's a partner that is doing a doctor's office, along with another less active partner, say one partner owes 20% and the other partner owns 80%, that pattern has to be the same in the rental property as well, 80-20 on both entities. Those are just a few of the key circumstances that have to be passed. I recommend that you connect with a CPA and review your situation on the front end before trying to claim this deduction. This is a part of a tax planning strategy that has to be planned out far in advance, at least a year. You have to make your elections, whether you want to be an S corporation or a partnership, in advance before you can start to take advantage of this tax reducing strategy of combining rental properties with another business. Thank you for listening today, and subscribe for more information like this.